and welcome to our interview series where we bring you face to face with the experts who manage your money. Today, joining me and my colleague Chirag is Ajay Argal, Senior VP and Portfolio Manager at Franklin Templeton. Welcome, Ajay. Good to have you here.
Thank you. Thanks for having me here.
Now, you were an engineering student. Can you please share what sparked your interest in financial markets and why the shift?
Right. So I was always interested in numbers, and that's why, as you know, in our generation, people who used to like numbers and maths, they used to start off with engineering. And that was always the ambition that one wants to get into IIT, and that's what I worked for, and luckily I got through. And once I got through IIT, it was quite exciting. I was in aeronautical engineering. But then as I moved on, I realized that at least at that time, the opportunities were very limited in India. And I wanted to stay in India at that point in time. And then gradually, during IIT itself, I took an economics course. I got very interested in that. So I thought it might make sense to try and do the management course. So then I aimed for the IIMs. And then when I got into the IIM, then as I looked at the various subjects and studied the various subjects, my interest veered towards finance. And then in the second year, I took mostly the finance courses with a view to get into the finance industry. So that's how I veered towards finance from engineering.
Mr. Argal, you had a long career in mutual funds, both in offshore as well as the domestic domestic managing money. What are the key learnings which you have gathered over the period of time?
So the learnings are many, but if one needs to summarize, the most important learning is that you need to continue to learn. So learning how to learn is the biggest learning, because the market is throwing up challenges every day, and it's different. You might try to use your experience and maybe spot some patterns, and then try to predict what's going to happen in the future. So it's all very helpful, but in every instance, there is something new which has come up, or something behaves differently. So the flexibility, the learning from that is really the thing which is different. You need to be humble. As stock investors, you will continuously make mistakes. So you need to be humble to acknowledge the mistakes and then move on from that. And the earlier you do it, the better it is. At the same time, it's a very thin line dividing, because you cannot be, too shifty. So you need to have very strong convictions, but at the same time, it should be kind of loosely held. So it might sound very contradictory, but basically, you need to continuously monitor your assumptions and then see how it pans out. And if things are not working out, then you need to change. So there are a lot of learnings. You need to work as a team, because it's a very complex system, as we study the complex systems in mathematics. So it's a lot of concepts of complex theory also works here. So you need to be getting inputs from all sides, and so your internal team and your external team, in the sense of the sell side, the support which you get. So all those things, you continuously need to be willing to listen and then incorporate that in your thinking, in your analysis, and then take it forward. So I would say the learnings are many, and it continues, it never ends. So it's always a journey. It's you never reach the destination. So that's the fun part. That's the challenging part, and that's why this line is so exciting.
Now, you mentioned the ever-changing market dynamics. So, reflecting on your time that you've spent in the markets, what are some of those, substantial changes, significant changes that the markets have undergone, and in your view, what are the most significant ones?
So many changes. The markets have totally changed from when I started off, so which was almost 30 years back.
Right.
At that time, the foreigners were just entering the markets, and even the domestic institutions were just kind of getting to invest more in a scientific way, or more in a way which has been done in the other developed markets. The market system structures itself was evolving as we were aware. Earlier, we used to have open outcry and then only BSE was there. So when NSE came, all the electronic trading, that really changed everything. The information gathering became much easier, and at the same time, it became much more democratic. So there was a lot of opportunities for people who were willing to do it on their own, unlike the period before that when it used to be very tough and it used to be kind of a closed club. So as a result, the market became more and more efficient. So I'm using efficient as an economic term. So basically, because more and more players came in, the price discovery was more realistic. Because earlier there used to be rather information asymmetry, and because of which the price discovery was not optimal. So, for example, even most of the times when I started off, we were not aware what the ongoing market price of a particular stock is because it used to be open outcry and you need to get it from the brokers or the members who were there in that exchange. And then whatever they said, you had to take it on face value because there is no way of checking it. And that is why, I mean, we have those kind of nostalgia people have of looking at the Bao copy in the evening to figure out what the rates were at the end of the day. And then over the years, of course, the market structures have improved significantly. The settlement systems, the trading systems. Basically, India is now at par or even better than, in fact, most of the developed markets as far as the stock market infrastructure is concerned. The regulations are very transparent, and even our industry itself, the information which is disseminated to the individual investors to make very educated decisions. That kind of thing has been very good. So that is something which has evolved over the years, starting off when the NSE came, and then when the industry kind of started building up. So I started my career with UTI, which was the only mutual fund for quite some time, and then some mutual funds came. Foreign mutual funds came, and then they left, and then other mutual funds built up. So there was a lot of participation from the retail investors, and the markets kept on getting bigger. The foreigners also participated more. So all these things actually led to a very good development of the markets. So the market has kind of totally changed. The size of the economy itself has grown substantially. So we are the fifth largest economy. So that's why there is a lot of focus from all the global investors. So basically, we are very important for the global investors. So that also shines a limelight on the economy. And similarly, the stock markets, we are the fifth largest. So again, a market which many cannot ignore. And then over the last few years, I would say last 7, 8 years, the culture of SIPs has picked up, and the retail investors have realized that such a fast growth in the country, the best way to participate is through the equity markets, and for the retail investors, an optimal way is to do it through the mutual funds and through the SIP route, which gives the disciplined investing. So all these developments have been very exciting to watch, and it has been in the right path. Maybe it is somewhat similar to what has happened in the other markets, but in some cases we have leapfrogged in terms of, as I was mentioning, the trading infrastructure which we have in the stock exchanges, the settlement systems. So yeah, there has been a lot of development in the markets.
Sir, as you mentioned, you started at UTI Mutual Fund when it was the only fund house in the country, later moved to Aditya Birla Sun Life Mutual Fund, and later to the Franklin Templeton. In between, for 7 years, you were with the Baring Asset Management in Hong Kong.
Right.
Could you share some light on how different was it managing the funds compared to the domestic equity funds?
Yeah, so not much different actually, because I was also looking only at India, even there at Baring Asset Management in Hong Kong. So it was just the difference was the perspective, because that was from a foreign portfolio investors because we were coming through the FPI route. So I got a better picture of how the foreigners looked at India. And that was because at Barings in Hong Kong, we had other funds investing into other countries, basically a China fund and an ASEAN fund. And then we also had the Global Emerging Markets funds where India was one of the parts. And of course, we had all the other developed market funds. So how the global investors look at India and what are the kind of things which they look, which maybe there is a 70-80% overlap in terms of what the domestic investors consider. But there is a kind of 10-20% things which they do differently or they do in addition because they have other opportunities available in terms of investing into other markets. And also, you get a lot of learning, which actually is the case even in Franklin. So, that learning is because you are a global organization. So, you learn from what is happening in the other markets, and sometimes those same situations, same industry dynamics might pan out in India after a certain point of time. And especially that was true in the technology sector, it is even true now. And even now, that kind of thing, I mean, I get a benefit at Franklin Templeton because we have a global setup. So there are benefits of having a global setup, which was the difference when I was managing in Baring Asset Management in Hong Kong, and that kind of thing is continued here in Franklin Templeton.
All right, moving on to your investment framework now. Can you describe your investment philosophy and what type of stocks or market situations excite you the most?
Yeah, so as you would be aware, Franklin Templeton is a growth-oriented fund. And we generally have a philosophy, what we call growth at a reasonable price, because our screening happens on growth, which is the starting point. But we are not willing to get into stocks at any price. So therefore, that marriage with valuation as well. So growth at a reasonable price is the philosophy. Within that, our investment framework is what we call the QGSV. So Q stands for quality, G for growth, S for sustainability, and V for valuation. So some of these things are self-explanatory. But if you look at sustainability, basically we are also focused on trying to identify the growth compounders, and that will be the predominant part of our portfolio. So generally, we would like to have stocks where they have growth year after year, maybe over 3 years, 5 years, 7 years, that kind of time frame, because that's the thing which you can kind of forecast. You can always forecast 10 years, 15 years, 20 years. But in most cases, even the company management themselves will be finding it tough to forecast over that time period. And also, you need to be nimble and continuously change if things are changing. So generally, we tend to think that 3 to 7 years is kind of the sweet spot as far as our investment horizon is concerned. And I say 3 years because typically 1 to 2 years is kind of efficiently discounted by the market. So you really cannot add alpha, or really cannot have a differentiated view from the market if you have a very short term frame. So that's why we try to identify in that investment horizon the growth compounders. And if you see, then generally across our funds, that's the reason that our portfolio turnover ratio would be in the range of 25 to 35%, which typically means that our holding period will be 4 to 4.5 years, that kind of time frame. So when I say that we have that kind of philosophy, it doesn't mean that we will just buy and hold. We are continuously reassessing our assumptions because we make detailed valuation models over the next 5-10 years. And obviously, the valuation models are only as good as assumptions. So, which are the inputs which you make in terms of the growth rates, in terms of the cash flows, what are the return ratios, what kind of capex they are doing, those kind of things. So when you make those assumptions, we are continuously checking them at least every quarter when the quarterly results come out, and we can update our numbers. And if there is some other significant development, we also try to incorporate that. So all that is a continuous process in terms of our investment, and that's how we try to get to identify the stocks. Our style is more bottom up, so we generally would focus more on the stocks and we have a top-down layover over that. So predominantly bottom up, but top down layer in the sense that if we are seeing some trends in terms of particular sectors we think are going to do well, then we would like to have consciously some overweight there. So we will try to identify more stocks in those sectors. So in that sense, so yeah, that's broadly the way we approach the portfolio construction in our funds.
Sir, given the entire strategy which you explained now, what makes a stock compelling by what makes a stock come into your portfolio?
So, for the stock to come into the portfolio, it should be a good combination of growth and valuation, as I suggested. And we would try to have a portfolio where there will be, as I said, a predominance of the growth compounders. So, in some of those cases, some of these growth compounders will be marquee names. So, you would find it very difficult to be kind of having the top two, three, or four names different from the market. But the real difference from the market, from your competitors, from the benchmark can come if you consciously try to identify stocks which are different. So we are focused on identifying stocks where we have mm, a different view, as I said, over investment horizon of ideally, let's say, 2 to 3 years, because we want to take slightly longer term view. At the same time, we don't want to take too long term of view because then if you're too early, it might be as good as wrong. So we try to get into that sweet spot of investment horizon 2 to 3 years, where we can have some difference of opinion from the market and only if you're different from the market, you can be having a differential returns. And obviously, those calls need to be right for us to be ahead of the benchmark and ahead of the competitors. So that's the thought process, basically trying to do something different from the market.
All right. What are your views on the new age tech companies, especially since you hold a few of them in your Franklin India focused equity fund? So
that's right. Yeah, so new age internet companies, very interesting space because we have seen across sectors that they are the disruptive forces. And by disruptive forces, basically, they are coming up with new ways of doing business. So they are shaking up the old ways of doing business in many sectors. It is not only one or two sectors. So obviously, those came in the radar when these kind of companies start getting listed in 2021. So in most of the cases, actually, we didn't participate in the IPO because we thought that at that point in time, the hype was a bit too much. The valuations were not so attractive, and at the same time, though the growth possibility was there, the profitability was not so much. There was a different thought process by the founders as well that they were just all focused on grabbing market share, is irrespective of the cash flows and the profitability. But that changed since they got listed because there was a bit of a correction in the Nasdaq, which was the driving force behind all the private equity players who have been financing these kind of companies globally and also in India. So kind of liquidity became a bit more tight. So that forced the discipline on these companies, and then they were forced to do the business in a more profitable way. So some of these in new age companies, they started focusing more on that, came up with strategies, and of course, they continue to have very good execution in terms of the growth. And at the same time, they put their heads together in terms of cutting costs and optimizing the costs so that they get closer to profitability. And we have already seen a few companies already being there or have a very clear path to profitability. And so we are again trying to for identifying the stocks there who are kind of leaders who have very dominant position, and also they have executed very well the industry space in which they are, that is having a lot of growth, and on top of that they will be having the market share gains. So we want to try to get into those kind of spaces where the industry growth is there as well as the market share gain is there, and where the managements have refocused their energies in trying to do profitable growth rather than growth at without bothering about the profits. So we have identified certain stocks, and as you can see, and as you are aware, that we have a couple of stocks in the Franklin India Focus Fund. So of course, we have other stocks in other funds as well, because Focus Fund, as you know, can have only 30 stocks. So we have identified a couple of them which we really think are having a good growth leeway on a profitable basis. And some of them has already contributed to our performance in the last 1 year or so since we have taken them. So we are continuously on the lookout for these opportunities. As I said, growth is kind of the easier part, because that's what they bring to the table in terms of doing things differently, and that therefore the opportunities open up in terms of faster growth. But we are also focused whether they are able to get a profitable growth. So we are very positive on that space, because that's these kind of companies have created a lot of value in other markets, especially the developed markets like the US, and therefore we think that a similar thing can happen in India.
Sir, but what do you think about the valuations of these stocks? If we talk about the 2021, when they got listed, the valuations were high. Then came a lean period when most of the funds participated. But and currently, again in the rising markets, they have seen sharp returns. So how do you look at the valuations?
Yeah, so valuations, there are two ways to look at it. One is the absolute valuation, and one is the relative valuation. So absolute valuations, as you are aware, across the sectors, in most of the sectors in India, the valuations are not cheap. Definitely, they may not be expensive, but they are not definitely cheap. So that the same is the category with these kind of stocks, that the valuations are not cheap. But when you look from a relative perspective, these stocks we think are in a better position, because they have much higher growth, and they also have a profitability path. So basically, the growth in terms of profitability, whether you look at in terms of the operating profit growth or the cash flow growth, is much more faster compared to the growth they are showing in the top line. So from the market, returns actually come from the growth, from the changes from the derivative, which is there in the numbers. So in terms of how the growth is in the operating parameters, the growth is very, very strong. So if you look at it from that perspective, and especially on a relative basis, we think that the valuations in this space is still reasonable. They are definitely not as cheap as they were maybe, let's say, 18 months back, but they are still there is room for positive surprise. If you look at in terms of their execution, in terms of growth in the top line, as well as the way they've demonstrated the profitability, especially in the last 3-4 quarters. And as I said, we are continuously monitoring that. So they need to continue that improvement in profitability. And if that continues, which is what we are expecting, then we find these stocks to be attractive.
Sir, now coming to the value as a theme that has done wonders in the last 4 years, particularly after the March 2020. Do you think that it can continue to outperform going forward?
Yeah, that is difficult to say, especially now, because as you rightly highlighted, all the value stocks have done phenomenally well. So in that sense, um, there is very little differentiation between value and growth stocks, because the primary differentiation in them had been the valuations. And generally, we have seen that the value stocks have lower growth, and that still continues. So for lower growth, in some cases, they are having similar valuations, so that becomes a bit of a challenge. But there are still pockets, let's say, for example, banking and financial services, and more so the banking itself. The valuations are very reasonable. It's only sector where the valuations are lower than the last 5-year medians. And it's a very large sector. Similarly, if you look at a sector like an IT sector, the valuations are are somewhere close to what the last 5-year medians have been. Though there the situation is a bit different in terms of growth, the growth is definitely lower than compared to what they were. So the point I'm trying to make is there are still pockets available, but your observation is right that a large part of the value basket have really done well. So typically in the past we have seen that the value stocks do well for less periods of time compared to what the growth stocks do. And that is for a simple reason that India is a growth market. India, as we all know, will have continue to have a GDP growth faster than most of the other major economies. And as a result, most of the companies will continue to grow faster than the companies in other countries. So it is basically a growth market. So from a longer term perspective, the growth will continue to do well. What they will do in the next 1 or 2 years, very difficult for me to say, because you also have to keep in mind in some of the cases, the growth stocks, the valuations are like typically very, very high. So you need to balance that. So from a relative perspective, I'm not so sure. From a longer term perspective, I would tend to think that the growth stocks will continue to do better than the values.
Sir, coming to the mid and small cap segment that has run phenomenally well in the last 2 or 3 years, do you think this momentum is sustainable? And what factors would drive the growth going forward in these two segments?
Yeah, so the mid and small caps, if you see the very long-term performance, they generally do better than the large caps. So if you look at the last 20 years, typically the mid and the small caps would have given a CAGR return of 2 to 3% higher than the large caps. So that is 2 to 3% higher return every year on an average basis for the last 20 years or so. And the reason that happens is because they have faster growth, because they are smaller companies. But at the same time, these stocks will have higher volatility, which means that when they fall, they could fall more. I mean, one way to measure it is the maximum drawdown, which is the fall which happens in a particular cycle. And typically, again, in that sense, we have seen that the mid and the small caps typically have maybe 10 to 12% higher drawdown. That is, they fall 10 to 12% more whenever the down cycle starts. So generally, for an investor, it's better to have a good balance in terms of the large, mid, and the small caps. So in the last two years or so, the mid and the small caps have especially done phenomenally well, and the valuations are basically on the higher side. So if you look at the Nifty valuations currently, they are very close to the 5-10 year averages, or maybe slight premium. But when you look at the mid cap, especially the mid cap index, the premium is very high. So the mid cap index itself is trading at close to 50% premium to Nifty, and which is basically the highest it has ever been. I mean, if you leave aside the COVID period when the profits were totally depressed for the mid cap, so the multiples look high. But apart from that period, this has never been the case that we have this kind of relative valuation. Same is the case with the small cap. The small cap index is trading at a 10% premium, and it trades very rarely at a premium because the small caps typically are much more riskier, even in compared to the large caps. And in some cases, one or two clients might be making very large part of the business, so therefore they have a lot of ups and downs, and therefore their valuations typically generally they are at a discount to the large cap. But that's not the case currently. So from a near-term perspective, we are a bit cautious on the mid and the small caps, and that is why you would see in our diversified strategies, whether it is the focus fund or the flexi cap fund, we have the weightage which is higher towards the large caps. So in the shorter term, we are a bit cautious, but as I said, in the longer term, and primarily you are coming to the market to participate in the growth. And as the growth will be higher in the mid and the small caps, it makes sense to participate in that as well.
Right now, looking ahead, are there any themes you believe could be particularly profitable for investors over the long term, or some that you've included in your portfolio?
Yeah, so generally over the long term, India will continue to do well because of the higher growth. And when we look at the themes more, it needs to be looked from a medium-term perspective, maybe 3 to 5 years, or maybe 2 to 4 years. So from that perspective, if you look, the most attractive at the moment, looking to us, is the banking sector, as I mentioned briefly. So it is a good combination of growth because growth is reasonable, maybe slightly higher or around the nominal GDP growth for the sector as a whole. And within that, I mean, we try to focus more on the private sector banks because of the phenomena of the gain of the market share, which they have demonstrated over the last 20 years. We think that's going to continue. The gain of market share from the public sector uh, banks. And as we are aware, the asset quality cycle is very benign in the sense that the credit growth has not been very strong to the corporates, especially, which is typically the seed for the non-performing loan generation. If we go back to 2007, 2008, when that cycle started, before that, there was a big lending binge, if you recall, to the power sector, for example. So that kind of lending binge has still not happened. So therefore, we think that the asset quality deterioration, that cycle, at least is 2 years away. So no worries on that front. And valuation, as I said, this is the only sector where the valuation is lower than the last 5 year averages, medians. So this is the best combination in terms of growth versus valuation. Then there are some other themes which are getting played at the moment. For example, the real estate sector, where the cycle has really picked up because if you go back 2 years and if you look at 10 years before that, the real estate prices didn't go anywhere, but the salaries went up. So the affordability increased substantially, and therefore, post COVID, when there was some pickup in the demand, the cycle really started. And typically, the real estate cycle continues for 4 or 5 years. So maybe we are halfway through that cycle. So obviously the stocks have already done very well, but as a theme that we think that there could be more growth going forward. Then there are other smaller themes like telecom, which we have already witnessed in terms of the tariff increases, and we think that there could be more tariff increases over the next couple of years. And of course, the data growth continues, though the subscriber growth is over. So there are those pockets where we think that thematically we can play around. And if you look at a fund like Build India, which also I manage, so that is a continuous evergreen theme, and this fund is now almost 15 years, and then during the entire period, the fund has given kind of returns which is better than the most of the diversified category. And the reason has been because India is kind of perennially deficit in this space in terms of the infrastructure is lacking. So we are seeing a lot of growth happening over the last 15 years. I think it will continue for many more years, whether it is ports, airports, roads. We have already seen railways and power, utilities, telecom. So all these form part of the infrastructure areas or the kind of make in India or the areas which are required for building the domestic economy of the country. So that infrastructure-based theme, in my opinion, is an evergreen theme. Right now, the valuations are a bit on the higher side. So from a shorter term perspective, it may not be good. But if you look at, as I was mentioning, the medium term, 3 to 5 years, we think that that is another theme which one can look at.
So don't you think that manufacturing or the defense kind of theme is, can see a growth going forward? You have not mentioned that name, so just curious to ask about the manufacturing and defense theme.
No, so that's part of the Build India, which I was mentioning.
Yeah.
So we already played that, but in some of the pockets, we need to be a bit cautious on the starting point at which we are. So you are mentioning the defense. So we have also participated in defense in Build India and even our diversified funds, other funds as well. But right now, the valuations we think are a bit on the higher side. I think the expectations are very high. If you look at some of the stocks, they are actually trading at valuations which are higher than the private sector uh, competitors, and that has never happened in the past. And the reason we think that that might be challenging is because these kind of companies have their own challenges. Obviously, there is only one customer, which is the government, though they are trying to expand into the export markets, and there has been some success. But the government has its own push and pull. We at various points in time, they might have to do expenditure in different areas. So whether it will be a secular growth area, which is what the current valuations are kind of estimating. We are not so sure on that. So, from that perspective, we are a bit cautious on that space.
Sir, coming to the Franklin Build India Fund, and we have seen this infra as a theme doing well in the last 3 years, and index is up by around 130% in the last 1 year. But
Correct.
most of the funds in this category has not beaten the index. So, what is the reason for this underperformance? Does it make any sense for investors to look into the active funds compared to the passive funds in such categories?
Right. I think that they should still look at the active funds. So we need to understand why this underperformance is there. So the primary reason is the benchmark, which is BSE Infrastructure Index, is very skewed. And it has stocks which are kind of illiquid or low floating stocks. So there might be like 30-40% of the index which could be in such kind of stocks. And that is why you would find that not only Build India Fund, but like most of the funds in this category have not ventured into some of the names which are there in the benchmark, and they have done phenomenally well. And we typically see that when the markets do well, all these kind of stocks where the floating stock is less, they will do much better. And that is what is the phenomena which has happened in the last 1 year. So just to give you a sense, if you look at a similar benchmark, which is called the NAC Infrastructure Index, which is much more, I would say, normal, because in the sense that they have much more emphasis on the floating stock in the way they choose the stocks for the index. So that is actually given, if my memory serves me right, around 60-65% return. So there is a substantial difference. And so basically, some of these stocks we have not invested in, which is there part of the BSE Infrastructure Index, because we don't find that it is good for the investors if we get in and try to get out of those stocks in terms of liquidity, in terms of building the position and then unwinding it when we try to book the profits. So, from an investor interest perspective, we have been cautious, not ventured into some of these names, and that's the reason that there is this kind of underperformance. But we have seen in the past that we have had outperformance of even 20%. So, in that sense, I would say that benchmark is not so representative because of these constraints.
Right now, once again, looking back at your career, what has been the most surprising market trend or event that you've encountered, and how has that influenced your approach to investing? It would be great if you could cite some anecdotes there.
Surprise! I think every day is a surprise. That is a fun and that is a challenge because as investors, you are continuously making assumptions. You're trying to predict the future, and obviously, it's kind of a black box. You're trying to see which see something which may or may not materialize. So, in that sense, there will always be a surprise. The question is, how do you react to that? What do you learn from that? So, that is how I think we started in terms of the learnings. Most important thing is to remain flexible, to continuously question yourself, to try to improve, to learn from your mistakes, to make less mistakes as we go along. You cannot eliminate the mistakes because, as I said, it is about the future and it is unknown. So it is not a science like a physics that if this is the input, that will be the output. So it's a mix of science and art. So it's also a very good way to learn about yourself because the fight or the challenge is always with yourself in terms of what mistakes you have made, what biases you have, So how you can try to reduce that, and the more you are able to do it, the better performance you will be able to give to the investors and kind of add more value to them. So that has been the continuous endeavor, and that is why there is an element of surprise kind of every day in terms of you make you're continuously making kind of predictions in terms of what is going to happen, and you are continuously getting the result, the feedback. So that feedback loop obviously gives you throws you a lot of surprises.
And if you had to pick one market trend or, some event that has taken you off guard, what would that be?
So I would say the kind of the market movement we have seen in the last couple of years, which has been driven, I would tend to think more by the retail investors. So this is a phenomena which, as far as I can analyze and recall, has happened for the first time. So this was building up, as I said, from to 2014 or 15, when there is substantial pickup of the inflows into the mutual funds, and also the SIP culture picked up. And then over the last couple of years, that is kind of magnified with the investors trying to uh, do it on their own, in addition to participating to the through the mutual funds. We have seen the phenomena where the individual investors have been very disciplined in the sense that they've continuously bought on down days, they've bought on dips. So that kind of discipline and that kind of consistent investment into the markets is something which I've seen for the first time in the last few months, and that has been a surprise.
Sir, what does a typical day look like for you as a senior fund manager at Franklin Templeton Mutual Fund?
We start off the day with the morning meeting. So the morning meeting basically discusses anything which our analyst team wants to highlight. And obviously during the result season, it is focused on the results, especially of the portfolio companies or even the companies which are not in the portfolio, but it is on our radar. So we discuss that in detail in the morning meeting. And then after the morning meeting, then it's a continuous interaction again with the analyst team, and that will be in terms of the requirements of the each of the portfolio managers. So I, as a portfolio manager, will be continuously looking at the stocks which are there in my funds which I run, and also the stocks which I have in my watch list in terms of whether I should be buying them by either adding them or by selling some of the other stocks which is already done well, or in some cases are not doing well for certain assumptions which has not worked out. So that is a continuous process. There is a lot of informal discussion going on with the analysts on a continuous basis to try to understand if something you have missed out, or if some development has happened. During the day, of course, there is continuous calls from the sell side. So which is basically up to the portfolio manager what we want to listen to and what we don't want to. So different portfolio managers have different styles. So for example, I particularly try to focus more on trying to think on my own. And of course, I mean, I do interact with the sell side, but I think that the value can be added only when you are trying to think on your own. So I try to set aside a lot of time for trying to figure out how the portfolio construction is looking on a daily basis, whether I need to make changes. And of course, sometimes we have the sales calls as well. So uh, trying to talk to various distributors or gatekeepers in terms of explaining the fund positioning, how do we manage the funds, etc. Calls like what we are having currently, so those kind of things as well. So yeah, I mean in that sense, it's a continuous process and it continues even outside. It is not as if once you go home, your mind is off, because you're continuously looking. And since, I mean, people who have been there for this long, obviously, like the job and like what comes with it. So we are continuously, even outside our work, looking, reading. The reading part is very, very important. The more you are able to read, the more you will be able to kind of grasp the trends which is happening globally in the country. So that is the endeavor, to try to keep yourself informed, try to continuously analyze. So that's what is the daily routine.
Right. Any word of advice for young investors?
Yeah. So all these things which we talked about in terms of trying to read more, trying to question yourself all the time, trying to learn from your mistakes, trying to reduce your biases, and investing for the long term. As the cliche says, time in the market is more important than timing the market. So that if you are longer term in the market, you will have more chances of compounding your wealth. And be patient. Don't try to become wealthy overnight, because that can work, but it can work in reverse as well. Because if it is working, then obviously you are taking a higher risk, and therefore it can work in reverse as well. So be more disciplined and be more diligent, and then just have an open mind.
All right, with that, it's time for us to wrap up this chat. Thank you, Ajay, for taking the time for this interaction.
Thank you. Thank you for this opportunity.